makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The SNB surprises some, becoming the first major central bank to cut rates, while markets now turn to other decisions, with the BOE and Norges Bank largely seen holding. European stocks and U.S. futures trade higher following another record for the S&P 500 after the Fed maintains its outlook for 3 rate cuts this year. Plus, Bloomberg learns that Barclays is planning to cut several hundred jobs within its investment bank division as part of an effort to trim costs and boost profits. Now, let's take a look at the European markets map again. The focus is on this marathon, really, of central banks. The Swiss franc has been on a downward path against the dollar since the start of the year. This is from our Venram. Today's surprise interest rate cut, as well as the central bank's lowered inflation estimate to 1.4% from 2%, will probably further accelerate the decline. Now, we have an expert voice on this shortly, so I'm looking forward to speaking to Philipp Hildebrand in a second. But you can see for the moment, we're seeing gains across the board. We're also looking at AI. We're looking at tech. It's a big old news flow day because we're also expecting the DOJ today to go after Apple because of its monopoly concerns. S&P futures for the moment gaining 0.4%. We're also seeing a little bit of a liftoff for the Nasdaq 100 and then European stocks getting 0.8%. A couple of other things we're watching out for. So again, it's all about central banks. It's a lot about what we heard from the Fed. Maybe not as hawkish as they could have been. Certainly, if you look at the dot plot, that's changed a little bit. And look at gold. It's the first time ever that we touched $2,200 an ounce. Swiss franc 0.9749. Norges Bank leaving the benchmark interest rate at 4.5%, so no change for Norway. Norwegian krona 11.4924. And then we go on to the Bank of England. Also no expectation in change. And if you look at the communication of Andrew Bailey, it's certainly been a lot more tentative, or maybe not as clear in terms of a timeline that we heard from the Fed and the ECB. Then we also have some news in terms of data. Euro area March manufacturing PMI coming in at 45.7. The forecast was a touch higher, but remember, anything below 50 still means a contraction. Again, that PMI, though, services, so manufacturing is not great. Services PMI rising to 51.1, and that's better than expected. So to the news of the day, the Swiss National Bank has cut its key interest rate by 25 basis points, acting months before global peers may follow suit. Now, it's a huge week for central banks with the Fed decision yesterday, the SNB and Norges today, the BOE coming shortly. So for more on all of this, to make sense of it all, really, let's bring in the Vice Chair of BlackRock, Philipp Hildebrand, who joins us for an exclusive conversation, also who knows the SNB and actually the Swiss complex intimately. So, Philipp, what a treat, what a day to have you on. It feels like momentous because it's the first major central bank to cut rates.
Yeah, we've been waiting for this for a long time. The market has been pricing it and had to come off, and now basically, the first one is out of the gates. Not surprisingly that it's the SNB, in the sense that Switzerland had by far the best inflation record through this difficult period of the pandemic. So it's a courageous step, but perfectly justifiable when you look at the inflation forecast and the inflation data these last couple of years.
So what does a policy mistake look like, not from SNB, but also for others? Is there a danger that actually if you cut too quickly, then inflation actually is rampant under control, and so it makes your job double harder to get on top of that?
I think the main challenge they face, all the central banks effectively, and certainly the Fed, is that goods inflation continues to come down. That's the post-pandemic adjustment. That will settle at roughly zero, which is where typically historically goods inflation is. What is not going to happen, in my view, is service inflation is not going to come down. We have very strong labor markets. Wages are strong. And so my guess is service inflation is going to turn out to be sticky when it settles. And in combination between goods at zero and service inflation somewhere around 3%, let's say, that suggests to me that what we're going to end up with a kind of a rate that is going to be higher. And so I think what you're going to see is a higher for longer story that will ultimately kind of feed through the short-term adjustment of rates now beginning to ease, policy rates beginning to ease.
Philipp, for many years, you were, of course, in charge of the SNB. We're now looking at live pictures of Thomas Jordan speaking to report. I know that room very well, gathered there to try and understand the path forward. He's also said he will step down. What's the intricacies on I guess, the complexities of just managing the Swiss economy right now?
Well, I think that, just keeping the track record of the SNB, the legacy of Thomas, of course, is that he has the best inflation track record of any central bank. And so I think that's the principal challenge going forward, to make sure that there's no question that credibility on inflation will be maintained. And then in the longer term, the question will be, and that's partly an SNB question, but more a regulatory question, how do you deal with a bank that is going to be very, very large compared to GDP? And that's, of course, the legacy, in a sense, of the failure of Credit Suisse. So those will be the main challenges going forward, I'd say, for his successor.
But would he be worried about market reaction right now?
No, I don't think so. I think he's, they've known
how the markets will react.
They know how to surprise markets. They've done that before. As I said, I think he could certainly perfectly justify the decision today. He could have also waited. But in a sense, when you look at the inflation data, the inflation forecast, there's not much point in waiting here, so why not go ahead? So I don't anticipate any problems. And if he gets a little bit of currency weakness out of this, then I think that's perfectly fine. So this will not create any major kind of market reactions. But it does signal to the world that we have kind of turned the corner, that central banks are easing, and then the question will be, where does all this settle in the long term?
Yeah, but then if you look at actually what we heard from Jay Powell, he was quite tentative, right? And again, he's a lot less hawkish, and even the dot plot gave us a lot less hawkishness that we could have seen.
Well, I think they've succeeded very well. Remember, when we last spoke in Davos, we had pricing in the market that was just not realistic. So the Fed has succeeded in squeezing that out. We're now looking at 3 cuts going forward. It seems pretty clear to me that the Fed is intent on cutting rates, so on following Thomas Jordan. And that will happen unless something terrible happens. What's also clear, though, when I look at the details of the charts, the dots going forward, that there is an implicit recognition that longer term the inflation path and the interest rate path is going to be sticky. There's kind of an implicit recognition that we are likely going to see a higher neutral rate level. He didn't explicitly say that, but if you look at the dots, it's there. The inflation numbers were actually slightly adjusted upwards for the next 2 years to come. And I think that's going to be the real story here. We are going to touch 2%. Inflation is coming down quickly, but it's mostly a goods inflation story. The real question will be, where does service inflation settle going forward?
Yeah, and actually, this is, one of my favorite authors is John Authors, and he has beautifully laid out, of course, exactly what you're saying. What does it mean for the economy? And there's an assumption, base case, but frankly, completely priced in the markets, that we have a soft landing.
Well, we'll have, I think what we will not have is a kind of what I would call an immaculate landing. We're unlikely to get a perfect sort of 2% inflation, no weakness whatsoever, rates going back to levels that we've seen before. The supply constraints that you and I have talked a lot about in the last couple of years are still going to be there. So I think the challenge is, how do we get out of a kind of higher for longer environment with relatively sticky inflation, which will lead to a situation where, unlike in the past where central banks had a kind of permanent bias to ease, they may have a longer-term permanent bias to tighten. And one of the answers, of course, to this dilemma would be a boost in productivity. And I think that, to me, is the big kind of longer-term question. Do we get a boost in productivity coming from AI or something else that kind of gets us out of this constrained environment of relatively low growth, relatively high rates, and relatively sticky inflation? Yeah,
and productivity in the U.S. is actually on a tear. We're listening to Thomas Jordan of the SNB saying that they will, of course, adjust monetary policy again if necessary. How much do you look at gold, Philip? I mean, gold at a record high. I don't know if it's symptomatic of actually, traders or other central banks not trusting the Fed, and whether that's a debt problem.
Look, gold is always a kind of a gauge of risk and uncertainty in the world, and we live in a very uncertain, very risky world, not just with regard to where inflation will settle, but with regard to a new trade order, fractured geopolitics. We have wars going on. We have very high debt levels, undoubtedly. The U.S. Fiscal situation has deteriorated, of course, quite dramatically in the last couple of years. It has helped in terms of the resilience of growth. You can see that Europe has much weaker growth because it didn't get as much fiscal stimulus. The price to pay is the debt. So I do think there are just lots of sources of risk and uncertainty that are embedded in the global economy, and that's what I read into the gold price rather than any kind of monetary or policy implication per se.
Okay, Philip, thank you so much. Philipp Hildebrand, of course, BlackRock's vice chair, stays with us. We'll talk maybe a little bit more about productivity and AI. Now, the outgoing SNB president, Thomas Jordan, will also speak to Bloomberg a little bit later on after the surprise rate cut. Now, on to some of the corporate news we're following. And Micron Technology surging pre-market after it actually gave a surprisingly strong revenue forecast for the current quarter, buoyed by demand by artificial intelligence hardware. Now, this is the largest U.S. maker of computer memory chips. It says fiscal third quarter revenue will be between $6.4 and $6.8 billion, topping the $6 billion penciled in by analysts. Now, Micron and rivals have had a tough time so far, and it seems that their fortunes are changing very rapidly. Much more to come. This is Bloomberg. Still with us, BlackRock's Vice Chair, Philipp Hildebrand. Philipp, we're talking a little bit about, of course, the Fed. We're talking about productivity, some of the challenges, and we're certainly talking about the Swiss National Bank. It's a pretty big week, actually, because we have the SNB, the first major central bank to cut, and then we had the Bank of Japan. Now, it's largely gone unnoticed by the markets because it was telegraphed, but after 17 years, I mean, are there lessons that we take from BOJ and the way they tried to reflate the economy?
I think it's kind of a textbook case, frankly, of how you get out of an extremely long regime into a new one. Now, in practice, of course, it was kind of, as you said, it was gradual. Yeah. But nonetheless, I think it was done it was really a masterclass in how you move from a very entrenched policy stance to a new one while keeping all the options open and not rattling the market. So to me, this really was a masterclass by Governor Ueda.
When you look at some of the outside forces, it can be politics, it can be, geopolitics, the resurgence or uncertainty surrounding China and its AI. How does that influence how the markets participate and what kind of economies we're left with?
The easiest way to think about it is if you look at a lot of what is priced in today, particularly in risky assets, there is a sense that we are going to somehow come out of this low growth, sticky inflation, high rate or higher rate environment. I think that assumption is implicit in the kind of very optimistic pricing that we see in markets, which, by the way, I think looks like it's set to continue given the Fed's communication yesterday. And implicit in that is something is going to help us get out of this supply-constrained world that leads to higher rates, lower growth, and stickier inflation. And the obvious candidate for it is, of course, a productivity boost that comes from AI. It could come from somewhere else. Productivity boosts, by definition, kind of come from innovation, which we can't predict. But that seems to be the most likely story. So I think the most interesting thing to do in the years and months and years to come is to sort of observe what can we see in the data that gives us more or less confidence that this unfolding of a productivity boost is actually going to happen. To put it differently, the world needs it desperately, frankly. Yeah. Because the new geopolitical regime of constrained production capacity is an uncomfortable one. And the one way to get out of it is you get a boost in productivity that then raises and increases production capacity of the world economy.
But is there a danger that actually the U.S. takes advantage of this more than anyone else? And we've seen the numbers, we've seen onshoring. We're questioning the end of multilateralism, and so you have a very strong U.S. economy. And the rest of the world is kind of scrapping for pieces.
There is a clear danger of that. If you look at the internet boom, right, that raised productivity probably by 15%, something like that, and of course created these enormous companies that we now all know in the U.S. And then we had the energy shock, which was a big disadvantage for Europe relative to the U.S. There's a risk on industrial competitiveness for Europe. I think that is in my view, very significant. So yes, I think this has to be a wake-up call for the rest of the world, particularly for Europe, to make sure that the next big boom, in a sense, that will create the next set of big companies, the next source of job growth, doesn't again happen almost entirely in the U.S. The tech story was largely missed by Europe, and the result is today you have almost, maybe one, if at all, kind of major tech company in Europe. What you want to make sure is that from a European perspective, that this doesn't happen again if AI is to be the next big source of productivity. We'll see. This is hard to predict, but I do think what we can say today is that the world needs, quite desperately in my view, a new source of productivity, a new boost to productivity, so that we can overcome some of the constraints on production capacity that we see in the world economy as a result of the new fragmented world.
We also know, of course, that BlackRock with the JP deal is trying to grow in private markets. So if this is the future, it changes also the way banks operate. I mean, it kind of changes the whole construct, right, of the financial world.
Yeah, I think we've seen for some time. We call this one of the several mega trends or mega forces. Of course, the kind of disintermediation, in essence, from the banking system towards capital markets, which has many advantages, but poses challenges, of course, for banks. And I think, one of the advantages here is that private markets are growing. One of the areas that the world is going to need desperately in the years to come is infrastructure, at a time when fiscal capabilities of the major countries are really strained, quite severely strained as a result of all the crisis fighting that we've had. And so the notion that you have to find ways to mobilize private capital, use public capital to incentivize it, and then mobilize private capital at scale in order to fund all the infrastructure investment needs that are clearly out there, whether it's in this country or, frankly, almost any other country, that we see as a great opportunity for our clients, which is why we've made a big effort to become a more important, significant player in the space of infrastructure investing.
$4.5 billion are going to the polls. The U.S. election probably the biggest one, where you could see the biggest shift. But there's the European Parliament elections. There's the UK. What does this mean for markets?
Well, it's a great source of uncertainty. I think for the world at large, it means, how do you think about the United States? Does the United States continue to be the guardian of sort of humanity's interests? Can you rely on the old security arrangements, even on the old monetary arrangements, the Bretton Woods system? You think about the international organizations. They all came out of a world where the U.S., in sort of enlightened self-interest, created a system that served the world well. And I think the big question that will be answered, not just in November this year, but frankly over the years to come, is to what extent do we continue to live in that kind of world, or are we really moving on a sustained basis to a much more fragmented world where different regions, different countries have to become, in essence, more self-reliant? And that would imply, of course, vast adjustment costs. Just think of security alone. If that were to be the case for Europe, this would imply major investments in security. A very different world. So, to me, the big question here is, I think it was Henry Kissinger who said the holiday from history is over at some point shortly before he passed. Do we have to prepare for a completely different world where the role of the United States is a different one than you and I and the previous generation have really become used to since World War II?
Philip, thank you so much. And of course, that goes to the cost of money and everything else. We'll have to get you back on really soon. I could speak to you for another 3 hours, but we do have other news to cover. Philipp Hildebrand, the BlackRock Vice Chair. Now, coming up, the slump in global deal-making continues. So we'll also bring you the latest on planned job cuts and at Barclays and Citigroup. That's next, and this is Bloomberg. Well, Bloomberg has learned that Barclays and Citigroup are planning job cuts in their investment bank divisions. With us now is Bloomberg's Tom Metcalf, who oversees all of our banking coverage in Europe and the Middle East. So what do you make of these cuts? Good morning, first of all. What do you make of these cuts at Barclays?
Good morning. No, I think they're pretty big news. So, these are, I would say, slightly different to the ones we see at Citi, which are much more linked to the sort of the deal-making environment. This is Barclays, looking at the size of its investment bank and going, as we've seen with their strategy, how can we make our investment bank more efficient? So these are pretty sweeping, hundreds of jobs. Looks like they're going to be largely in, say, maybe the more capital-intensive environment, if we listen to what Venkat was saying on those things. So, we knew something like this was probably brewing, given that strategy, but it is when you see it in, sort of confirmed with hundreds of jobs, that's a big change.
It's a big change, but they still have global ambitions. So how do they square the two?
And that's the challenge, right? That's what Barclays got to wrestle with. They're relatively effectively shrinking the investment bank within the size of the group. But how can they still keep that global ambition? They've been very clear that's what they want to do. And, it's that challenge, really, for the Barclays investment bank is, can you basically do more with less?
Tom, as always, thank you so much for joining us. Tom Metcalf, they're in charge of our banking coverage with some great Bloomberg scoop this week. Now, we'll look ahead also to the Bank of England's rate decision. This is after the SNB was the first major central bank to cut interest rates. We'll look at BOE. We'll look back at Fed. This is Bloomberg. The SNB surprises becoming the first major central bank to cut rates, but nor just holds. Next up, the Bank of England. European stocks and U.S. futures trade higher following another record for the S&P 500 after the Fed maintains its outlook for 3 rate cuts this year. Plus, Bloomberg learns that Barclays is planning to cut several hundred jobs within its investment bank division as part of an effort to trim costs and boost profits. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, for the moment, you're seeing U.S. stocks, actually U.S. futures on the rise. A lot of the focus is on what we heard from the central bank, so from the Fed. The stocks rally certainly continues on these rate cut hopes. If you look at Swiss franc, it's sinking because of what we heard from the SNB. But really, the equity market optimism has been really reignited after Fed policymakers kept their outlook for 3 cuts this year, despite a recent rebound in price pressures. We also heard from Jay Powell really continuing to highlight that officials would like to see more evidence that prices are coming down. We're getting some UK data PMI, so manufacturing PMI, a touch above expectations. When you look at services PMI, falling to 53.4%. Manufacturing still below 50, so contraction. Services above 50, so in expansion. I don't know whether we have a sterling chart, but we'll get to that in a second. You can see gold. This is also the other big story of the day, 2,200 at a record high. It's interesting, half the people we speak to say, look, this is basically other central banks worrying about what the Fed does, or certainly worrying that they just will hit a snag because of their debt levels further down the line. And then others saying, look, it's unclear why gold is going up so much because it's just a hedge against inflation risk and possibly even geopolitics. So let's discuss now in depth another central bank in focus today, the Bank of England, expected to keep rates at a 16-year high, giving more time for inflation to cool before it loosens policy after the quickest tightening cycle in decades. Well, with us now to preview today's decision, Hannah Gooch-Peters, global equity investment analyst at Sanlam, and Dan Hansen, Bloomberg Economics chief UK economist. Now, I have a million questions about the SNB, which we'll get to on in a second, on gold. But Dan, and we start, you sat down,
Yep.
and I always actually tap down for information. I mean, I'm literally always emailing him saying, what do you think about this and what do you think about that? Given the SNB, given what we heard from the Fed and even the BOJ, does Bank of England take that into account, or do they just look domestically at what's happening and try not to mess it up?
Yeah, I mean, I think it's interesting, this one. I mean, obviously no one's expecting a move in terms of rates, but we've got 2 things that I think that are important for this decision. The first is the vote. So are those 2 policymakers that voted for hikes in February, is that hawkish dissent going to fade away? Because we've had some pretty good inflation data, we've had some pretty good wage data. The other thing to look at is the guidance. We're still talking about restrictive for an extended period of time. That's a sort of turn of phrase that the bank uses. I think something that will be interesting to watch is whether they recognise the fact that by bringing rates down just a little bit, we'll still be in restrictive territory. And that's something Hugh Pill has mentioned in speeches. And I think that's somewhere, I don't think they'll do it today. I think it'll probably be in May. But I think that's somewhere to look and to watch to see if they're becoming sort of keener on the idea of bringing rates down a little bit.
But Dan, they seem to be less committed because of the complexities also of the UK economics. So they're less committed in terms of timeline than the ECB and the Fed. Again, is it because it's more complex or because they don't want to get it wrong?
I think it's because they got burnt last year really badly. So in February, if you remember back to February last year, they kind of signalled they were done at 4% and they felt quite comfortable at that level. And then we had these two big surprises in the spring where inflation shot up. We ended up getting a late cycle 50 basis point hike in June. Then inflation surprised to the downside and they paused. So they're very much in this meeting by meeting approach. So I think they're very, and because you've just seen the PMI, the economy's not falling off a cliff, they've got time. So they're going to just hold out that a little bit longer to be sure they're going to get it right and not sort of preside over a resurgence in inflation.
And Hannah, we've heard this for the last 6 months, right? Central banks in general are just saying to the markets, watch out, hold down, slow down, let's look at the data. And markets kind of running away with some kind of, narrative. What are you expecting from the BOE?
Well, I think that if you look at the UK equity market, it kind of says it all. So it's massively lagging the US market again this year. It's not really going anywhere, and I think that the only stocks that are really moving hard in the UK market are those ones that are those big international earners. So you've got your intercontinental hotels, you've got companies even like Sage in technology, small business accounting software technology, doing exceptionally well, and then you've got your UK domestic stocks again sort of lagging. So I think that the UK market is very much focused on companies that are able to grow their earnings outside of the UK, and the domestic story for the UK I just don't think is playing out very well.
But so what does that mean for how we look at the investment in asset classes? I mean, there's gilts. I keep on hearing that maybe this year is the time of the UK because we'll have a relatively boring UK election, and so compared to other places in the world, it'll be seen as a stability, beacon of stability even.
I think that if you're having challenges with things like higher rates and inflation, then you've got to focus on quality. So it's companies that are able to pass these pressures through to their end customers, and also that they're trading on reasonable valuations because of this higher rate environment, also higher bond yields. So I think it's just a story of selectivity, and this concept of narrowness that we're seeing in the US market isn't unique to the US market. You'll also see that very much in the UK market. You see it very much in the European market. So it's just about selectivity from here if you're trying to look forward to improving your return expectations the rest of the year. So focus on international companies that are leaders in what they do and have the ability and the durability of that earning stream, I think, is really important this year.
So Hannah, is the US still the most attractive place with because of also what the BOJ does? Is Japan the same?
I think that the US just naturally has more higher quality companies available. So I think that it's a better fishing ground to go. But ultimately, I'm not really fussed about where companies are listed. These are all big international earners. But I think that the concentration you've seen in the US market in particular is really starting to offer up opportunities. This higher rate environment that on a headline level seems to be ignored by the US market. You've got the S&P up sort of going on 10% this year. It's very much driven by a few stocks. So underneath the surface, you are seeing the impact of higher rates on companies. You've got companies like the big health insurers are trading on valuation levels that haven't moved for 5 years. You've got companies like the exchanges, for example. These are fantastic, high-quality companies, but the valuations are actually looking, very compelling versus the sort of headline level of the S&P. So I think just be willing to look underneath the surface, underneath those big constituents that are driving equity market returns, be that in the US, Europe, or the UK.
Yeah, anything with debt? I mean, do you look at debt or some of the corporate bonds, certainly corporates? Because then I want to ask you about what you do with gilts and the kind of moves that we could see there.
Well, I think that if you're looking for real returns, I'm very much positive on the equity market. If you're wanting to beat inflation over the long term, and if you're wanting to, get away from this problem of a higher rate environment, I think on the impact of markets, I think that. Debt is very important in terms of balance sheet sort of quality for companies. So you don't want companies that have got a lot of debt on the balance sheet because you don't want to have to worry about how they're going to service that. So again, high quality, clean balance sheet, durable earnings growth, a reasonable valuation, I think, is very much where you want to be placed in this environment.
John Arthurs has a really brilliant piece today also looking at some of the dot plots in the US and how they've moved. And again, he talks about the neutral rate, and maybe one of the most important things that we've heard instead of, the dot plots is basically some of, for example, the median estimates that they're expecting for neutral rates. When you look at how the UK could be reformed. So we have the Ben Bernanke review coming up.
Oh, yeah.
Is there anything? The BOE seems like it's in an okay place in terms of communications. Am I wrong?
Maybe. I mean,
I'm a little bit optimistic. I mean, El-Arian actually says that at least they've always been upfront.
They have. I mean, I think they could be more upfront, to be perfectly honest with you. One thing, and we've written a note about this, I think Bernanke could suggest is that they publish their rate, what they think is the best or the most likely path of interest rates going forward. So slightly different to the dot plot, where what they would do is use that interest rate path in the model and use that in their forecast. Because I think if you look back over past forecasts, at least recently, for example, in November 2022, when we had the mini-budget meltdown, the bank put out a forecast of a very long protracted recession, a massive undershoot in inflation, because rates were too high in the market, but it takes the market curve into its forecast. And so you're putting out a forecast that you just don't believe, essentially. So I think one thing he will very likely suggest is that they just basically come clean a bit more. And going back to that point I was making about moving meeting to meeting, putting something out there that tells you about the longer-term path of interest rates, because that matters for mortgage rates, and obviously that matters for individuals, and it matters for the transmission of policy. So I think that would be a sort of important step and something he could potentially recommend.
All right, thank you both for joining us. Dan Hansen there from Bloomberg Economics and Hannah Gooch-Peters from Sanlam. Now, coming up, you're looking at live pictures from Brussels of EU Commission President Ursula von der Leyen, where EU leaders are gathering to discuss key issues in security, defense and foreign policy. With support for Ukraine top of the agenda, we'll also bring you an exclusive conversation with the country's Prime Minister. That's next, and this is Bloomberg.
Readily available source of low-emission electricity. Extending the safe operation of today's nuclear fleet is one of the chief.
So we have assurances from United States Senate because they approved this draft law. So now we are waiting decision of Congress. We have very active dialogue and negotiations with many congressmen from both parties. We have bilateral and bipartisan support from the Congress, and I believe that during the nearest time, this month or maximum next month, we will have this good news from United States, and United States will join to European Union, to G7 coalition. Military and financial support of Ukraine in this battle with Russia.
The rhetoric changing here in Europe. We heard Emmanuel Macron, the president of France, talking about potentially boots on the ground in Ukraine. We hasten to add that that's not something that Ukraine has asked for. But do you take a message from that? Is there more urgency here in Europe? And also, would you welcome boots in Ukraine from Europe, even in non-combat capacities?
I should say that for the last 1.5 years, maybe 2 years of full-scale aggression, mindset of many European politicians is changed dramatically, and it's very good news for all of us, because we understand that Russia is aggressor, is terrorist country, and Ukraine now is protecting European borders. So we are very glad that President Macron communication is much stronger. It's very concrete, very clear, and this is what we all need, not just Ukraine but all European Union. We should be very concrete, very fast, very clear, because the only way to fight and to liberate in this full-scale war with aggression of terrorist country such as Russia.
Well, that was Ukraine's Prime Minister speaking exclusively to Bloomberg's Oliver Crook. Now, Ollie joins us now from Brussels, where EU leaders are meeting today to discuss key issues, including security, defense and spending. Ollie, so center stage will, of course, be talks about freezing Russian assets. What are EU leaders saying?
Yeah, Francine, so really at the heart of this question here is how do you make the financing for Ukraine, put it on sustainable and durable footing? Because we're talking about tens of billions of dollars, and despite all of the goodwill that there is to Ukraine, when you're talking about those kinds of sums of money, things become complicated within the EU, and as we've seen within the Congress in the United States, where that aid package is still stuck. So the question is, where could that money come from? One of the answers that might solve that is these frozen Russian assets, of which there are about 260 billion euros worth within the G7. 200 of those sit here in Europe, and that throws off about 3 billion euros a year in terms of profits on those assets that the EU now wants to discuss about how to disperse that over to Ukraine. Now, you need consensus and you need a sort of majority, or not just a majority, you need unanimity from the member states in order to move forward with something like that. So it's very complicated. So they're trying to find ways in which there could be language which all member states could get behind. And we spoke to the Ukrainian Prime Minister about this issue. Have a listen.
Now, European Union have made first step, confiscation of revenue of these frozen Russian assets and usage this for Ukrainian needs, for urgent Ukrainian needs. And we believe that this is only the good sign and only the first step. And we continue discussion how legally and politically organize this confiscation of frozen Russian assets.
And at the end of his answer there, he's alluding to the fact of not just using the profits from the Russian frozen assets, but the underlying assets themselves, which obviously the Ukrainians would be in favor of. However, the United States is also in favor of this. And Biden and the administration want to make progress on the dialogue with Europe about this before a G7 summit in June, where they would potentially look at using those assets to fund the war. And again, there are 260 billion euros worth of them. So that would take it a very long time indeed.
So they'll also only discuss broader European defense. What will they talk about?
Yeah, so the question here is also another question of financing. So we had earlier from the EFO this week doing a sort of study on how much money is actually required for all of the European NATO states to reach their targets, to hit that 2%. How much money is that? It's 56 billion euros. How do you finance that? One of the questions is talking about the European Investment Bank. They want to change the rules there so that they can take the funds from there to lend to military application. Right now, it needs to be both civilian and military applications. They want to change the rules. There you seem to have some consensus. The 14 member states have signed up to this. You just need a simple majority to change that. But that fund only has about 8 billion euros in it that can go to military. That leaves a huge gap. So this will then bring into the fore this big conversation, which is a much longer discussion. But we understand the French are keen to push it today, which is, again, this idea of joint debt to help finance boosting European military, which, as we know, is in a sort of very precarious state, particularly ahead of a U.S. election, which could bring certainly some new questions for NATO.
It certainly could. Ollie, thanks so much. Oliver Crook there live in Brussels for us. Now, coming up, it sounds like science fiction. A paralyzed man is able to control video games with the power of his mind. We explain after the break. And this is Bloomberg. Well, chess is often called a thinking game, but Neuralink is taking it to a whole new level. The brain chip company founded by Elon Musk has shown its first patient playing online chess and other video games using his mind. Well, Nolan Arbog is quadriplegic after a freak driving accident 8 years ago. He said the surgery was super easy and has changed his life. Now, the video also lifted Chinese stocks related to brain implant technology, with innovation medical management rising close to 4%. Let's discuss all of this with Bloomberg's Alex Webb. First of all, Alex, I was alerted to the fact that you have, China brain stocks, which I didn't really know was a thing, and I don't know how far away we are from this being developed much more widely.
Yeah, I think that's the crucial thing here, right? That ultimately, this technology in itself is not necessarily bleeding edge. There are a lot of people doing this sort of thing. I think there were some comments from academics saying, great, this is a good starting point, but ultimately this is something we knew was possible. The crucial thing here is about the industrialization, the commercialization of it. And this is clearly something that Elon Musk has pretty decent track record at doing. Not out and out successful with everything, but when you look at obviously SpaceX and Tesla, he's got a good track record at taking things that seem sometimes like kind of pie in the sky ideas and commercializing them. He also has access to a huge amount of capital. So if he is able to, bring this somehow to market, it's nothing immediate, it would seem. There will be a lot of other companies riding on its tails.
Alex, what would it be used for? So again, this is a very specific case, and it helps people communicate and do things that otherwise they would not be able to. It's for science and for medical reasons.
Yeah, I think that's certainly the first sort of frontier on this stuff, right? It's the kind of the medical applications, people like the quadriplegic gentleman in this particular case. You can imagine a world where not only are they playing chess, but perhaps steering a wheelchair, right, with this implant. I think in Elon Musk's world, he also would love to have a future where actually, everyone would have this sort of thing, or someone without a medical condition could have it, in order to control parts of, say, you have smart glasses, for instance, and you control what's going on there. But that is a very long way away.
Okay, Alex, thank you so much. It did really read like science fiction, certainly when we were looking at some of the images. Our Alex Webb there looking at technology. Now, Reddit has raised $748 million in an IPO priced at $34 a share. That's the top of the marketed range. To discuss the latest addition to the NYSE and other U.S. corporate stories, we're also joined by Bloomberg's Charlie Wells. Charlie, this is exciting. So we've been talking about Reddit for quite some time, but it goes public in just a few hours.
Yeah, so what I would say the theme of today for Reddit, at least at this point in the morning, just a few hours from this stock going public, is so far so good. And I mean that in so many senses of the term. I mean, they've come so far since 2005 when they were founded. They've come so far since 2021 when they initially filed for that IPO. And so far, things are looking good. They were able to price at that upper end of their range. But let's see what happens in just a few hours.
The other story is, of course, the U.S. Justice Department, we understand, is poised to, as soon as today, basically tell Apple that they're violating antitrust laws.
This is a striking escalation of the Biden administration's antitrust fights with big tech companies. So Apple is the latest to this list. The Department of Justice is already suing Google for monopolization. The FTC is going after Meta and Amazon as well. But this is striking because the DOJ has actually sued Apple 3 times in the past 14 years on antitrust violations. But this is the first time that they are saying that they illegally tried to maintain their dominance in the market.
Okay, and then the other story we're looking out for is, of course, Micron. And this is on better than expected forecasts.
It really is. And I mean, this kind of demonstrates the kind of Midas touch that AI is really having for a lot of different industries. And so Micron is the largest U.S. maker of memory chips. And if you'll recall, just a few months ago, there was a really big issue in the memory chip industry because of weak demand for smartphones, weak demand for laptops. And so, look, memory gets used a lot in a lot of AI software. A lot of AI hardware needs this. And so this was a boost, and their shares were up 15% in late trading.
Okay, so interesting. Charlie, thank you so much. Charlie Wells there with the very latest on some of these U.S. companies that we're watching. Now, let's recap our main story of the morning. The Swiss National Bank cut its key interest rate by 25 basis points, acting months before global peers may follow suit as policymakers try to prevent gains in the franc. Now, you can see at the moment, Euro Swissy 95 or 97.552. Now, a little reminder that a little bit later this morning also we'll bring you an interview with the outgoing SNB president, that's Thomas Jordan, after the surprise rate hike. The picture across the board for markets is definitely left, right, and center what's been going on with central banks. Stocks still rallying actually to all-time highs. Tech and commodity stocks really leading the charge in Europe, but also it's probably leading some of the gains in the NASDAQ and the S&P futures. Traders in general, not only in the U.S., but also in Europe, growing more confident on the path for lower interest rates. Now, equity market optimism has really been reignited after the Federal Reserve policymakers kept their outlook for 3 cuts this year despite this recent rebound in price pressures. The chair, Jay Powell, continued to highlight officials would like to see more evidence that actually prices are coming down. He also said it will be appropriate to start easing at some point this year. I'm looking at Treasuries steady, the dollar posting smaller moves. I'm looking at Brent trading above $86 a barrel, Bitcoin holding on to 67,000. This is Bloomberg.